Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hammond here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. All right, Sandy, let's start off with some exciting news in the Canadian housing market. Housing starts in Canada jumped by 14% in September compared to the previous month, which was quite a surprise to many economists. The Canada Mortgage and Housing Corporation reported a seasonally adjusted annualized rate of 279,234 units, up from August's revised number of 244,543. Economists initially expected a more modest increase to 255,000 units.
That's right, Steve. It's definitely a significant uptick and seems to signal some ongoing resilience in the market despite challenging conditions. But it is important to note that this growth is largely driven by rental apartment construction, particularly in major centers like Toronto and Montreal. In fact, these two cities were responsible for more than a quarter of the total monthly starts nationally, primarily due to increased rental apartment starts.
Exactly, Sandy. And while it's great to see such growth, we should also be mindful that these housing starts reflect decisions made months or even years ago when investor confidence was higher. The current market conditions are quite different, and that could affect future projects.
True, Steve. And it's interesting to see how rental construction is leading the way. In Montreal, multi-unit starts surged by 135% year over year, and in Toronto, the increase was 112%. On the other hand, Vancouver saw a 1% decrease in starts for the month.
The numbers really highlight the importance of rental supply in our largest cities, especially when considering the ongoing affordability challenges and the persistent housing supply gap. But as we know, higher material costs, partly due to new United States tariffs on Canadian softwood lumber and finished wood products, could impact this growth. It might lead to increased home prices and renovation expenses, potentially slowing down new construction.
Absolutely, Steve. And industry voices are warning of a deeper crisis. Kevin Lee, the chief executive officer of the Canadian Home Builders Association, pointed out that housing starts are essentially skewed by the construction of purpose-built rental accommodation. Toronto mortgage agent Kalson Jang also mentioned the need for government intervention to make it easier and less costly for developers to build homes. The red tape and additional costs could deter builders, especially in a slower market. All right. Let's shift our focus to Canadian home sales, which dipped by 1.7% in September compared to August. This decline has broken a 5-month streak of gains that started in April. It's quite a shift, Steve, and it seems the dip was most pronounced in areas like Greater Vancouver, Calgary, Edmonton, Ottawa, and Montreal. Meanwhile, Toronto and Winnipeg saw some modest increases.
Yes, Sandy. Although it's a decline, it is important to keep in mind that September's sales activity was still quite robust when compared to recent years. Sean Cathcart, the senior economist at the Canadian Real Estate Association, pointed out that this was the highest level of sales activity for September since 2021. So, while the momentum took a slight breather, it is not necessarily indicative of a downturn.
Absolutely, Steve. And with the pent-up demand from the past few years and more stable interest rates now, the forecast suggests that we should see upward momentum in home sales over the final quarter of this year and into 2026. It seems like the market is poised for a rebound.
The home price index did edge down by 0.1% month over month, which shows some price stabilization. However, the unadjusted index dropped 3.4% compared to September 2024. The national average sale price did tick up slightly by 0.7% year over year, reaching $676,154.
And even though new supply slipped slightly, with the number of newly listed properties down 0.8% month over month, the overall inventory levels are still quite tight. We're seeing 4.4 months of supply nationally, which is below the long-term average of 5 months. This tight inventory could continue to influence market dynamics.
Yes, and the sales to new listings ratio eased a bit to 50.7% from 51.2% in August, which still falls within the balanced market range defined by the Canadian Real Estate Association. It's a delicate balance, but it does suggest a steadier market environment.
And looking ahead, CREA's latest forecast is projecting a 1.1% decline in home sales for 2025, but a significant rebound of 7.7% in 2026. They're also expecting average prices to fall by 1.4% next year before rising by 3.2% in 2026. So, while we're seeing some fluctuations, the long-term outlook remains positive.
Exactly, Sandy. Valerie Pacan, the chair of the Canadian Real Estate Association, mentioned that although there are more buyers in the market now than at almost any other point in the last 4 years, sales activity is still below average. But she expects things to steadily pick up going forward. It's a market in transition, and it will be interesting to see how these dynamics play out.
Let's dive into the latest data from the Canadian Real Estate Association. September. Home sales have shown a robust increase of 5.2% from the previous year. This represents the most activity for the month since 2021, with 39,700 home sales across the country, up from 37,721 in September of the previous year.
That is a solid increase, Sandy. It's interesting to see that the Canadian Real Estate Association has adjusted its forecast for home sales in 2025. Initially, they projected a 3% decline, but now they're expecting a softer 1.1% decline. This shows some resilience in the market, especially considering the ongoing economic challenges.
Absolutely, Steve. And it's worth noting that the improved forecast comes after several downgrades earlier this year. Back in January, the association expected an 8.6% year-over-year increase for 2025. However, the economic landscape, particularly with the impact of tariffs from the United States, forced them to revise their expectations.
Yeah, those tariffs have definitely cast a shadow over the economy. But despite these challenges, the forecast suggests upward momentum in home sales over the final quarter of this year and into 2026. The Canadian Real Estate Association now anticipates a rebound of 7.7% in 2026, which is quite optimistic.
It's a promising outlook, Steve. Although the association did mention that decreases in activity are still expected in British Columbia, Alberta, and Ontario, which could offset gains in other parts of the country. So it's a bit of a mixed bag depending on the region.
That's right, Sandy. And in terms of home prices, the national average is expected to fall by 1.4% in 2025. However, they're projecting a 3.2% increase in 2026. The forecast indicates that only British Columbia and Ontario would see declines in average home prices, while most other provinces could see price gains between 4 to 8%.
It's interesting to see these regional differences in the market. Sean Cathcart, the senior economist at the Canadian Real Estate Association, mentioned that with 3 years of pent-up demand and more normalized interest rates, we could see further upward momentum in home sales as we move forward.
Yes, and Robert Kavchich from BMO noted that while sales have improved, affordability remains a challenge. He pointed out that potential homebuyers might need further price declines or lower mortgage rates to ease market conditions. If we see mortgage rates drop to the low 3% range, it could indeed spark more activity.
That's a good point, Steve. And while new listings dipped 0.8% from August, there was still a 7.5% increase in properties listed compared to the previous year. This indicates a bit more availability, although inventory remains tight overall.
It's a complex picture, Sandy, but the market seems to be finding its footing. It'll be crucial to watch how these dynamics evolve, especially as we approach the end of the year and look toward 2026. The interplay between supply, demand, and economic factors will certainly keep us on our toes.
Steve, let's delve into the latest updates from the Canadian Real Estate Association concerning their forecasts for the resale housing market in 2025 and 2026. It looks like they have revised their expectations downward a bit for 2025, anticipating a 1.1% decline in home sales compared to 2024.
That's right, Sandy. The initial forecast was more optimistic, expecting a recovery this year fueled by pent-up demand and lower interest rates. However, the economic uncertainty and tariff issues earlier this year seem to have delayed the anticipated rebound.
Indeed, Steve. The impact was particularly felt in British Columbia and Ontario, where activity slowed considerably. But since March, there has been a steady upward trend in home sales, suggesting that while the rebound was delayed, it was not derailed entirely.
Exactly, Sandy. And looking ahead to 2026, the forecast is quite optimistic, predicting a 7.7% increase in national home sales. This would bring the number of transactions to over 500,000, a level we have not seen since 2021.
It's an encouraging outlook, Steve, especially considering the challenges earlier this year. The Canadian Real Estate Association's forecast also indicates that the national average home price is expected to decline by 1.4% in 2025, but rebound by 3.2% in 2026.
Right, Sandy. The declines in 2025 are mainly expected in British Columbia and Ontario, which are among the more expensive provinces. Yet, most other provinces are forecast to experience price gains ranging from 4 to 8%.
It's interesting to see such regional variations, Steve. While British Columbia and Ontario might face declines, the rest of the country seems poised for growth. The forecast implies that the overall market is balancing out, albeit with some regional disparities.
True, Sandy. And it is important to note that while these forecasts are based on current data, they are still subject to higher than normal levels of uncertainty. The economic landscape can shift, impacting these projections.
Absolutely, Steve. With the Canadian Real Estate Association set to update their forecasts again in January 2026, it'll be crucial to keep an eye on how these trends develop. It seems like we're in a market that is gradually finding its footing amidst various economic pressures. It seems like the cost of renting in Toronto is climbing higher and higher, Steve. According to a recent report by Zoocasa, Torontonians need to earn about $44 an hour to comfortably afford a one-bedroom apartment. That's quite a steep requirement, especially considering the minimum wage in Ontario is just $17.60 per hour.
You're right, Sandy. The gap between the minimum wage and what's needed to afford a one-bedroom apartment in Toronto is staggering. The report highlights that renters should ideally spend no more than 32% of their income on housing. But with the average rent for a one-bedroom unit in Toronto at $2,295, it's clear that many people are being priced out of the market.
It's definitely a tough situation for many Torontonians. The report suggests that to meet the 32% rule, individuals would need to earn at least $86,062 annually. That's a significant jump from what many are currently making.
And it's not just Toronto. The report also points out that across the Greater Toronto Area, places like North York, Mississauga, and Brampton all require hourly wages above $40 to afford similar accommodations. Even cities outside the GTA, such as Greater Sudbury and Waterloo, show significant wage gaps.
It's concerning to see that even cities once considered more affordable are now less accessible to full-time minimum wage earners. Zoocasa notes that housing costs are outpacing wage growth at nearly every level. Incremental wage increases aren't enough to close this gap.
Right, Sandy? The report emphasizes that Ontario's housing costs continue to surpass wage growth, which raises questions about the effectiveness of current wage policies. It seems like there needs to be a broader approach to tackle this affordability issue.
Absolutely, Steve. The disparity between income and housing costs is a growing concern, and it requires attention from policymakers. As the report suggests, the current incremental wage adjustments aren't bridging the affordability gap, and more comprehensive solutions might be necessary.
It'll be interesting to see how policymakers respond to this data. The numbers clearly show that more needs to be done to make housing affordable for everyone, not just in Toronto but across Ontario. It's a complex issue, but one that needs addressing sooner rather than later.
Toronto's condo market is experiencing a notable shift, with increased inventory and stabilizing prices that are giving buyers newfound leverage. According to a report by the Toronto Regional Real Estate Board, the average condo price in the city fell to $655,231 in September, marking a 4.3% drop from last year. In Toronto's core, prices were slightly higher at $681,115, but still reflected a 3.8% decrease. Meanwhile, the suburbs saw a more significant decline, with prices dropping 5.4% to $606,275. These are the lowest condo prices the region has seen in at least 4 years.
Yeah, Sandy, this drop in prices and increase in listings is creating a more favorable environment for buyers. With the market not as competitive as before, financially prepared homebuyers have more opportunities to negotiate and secure value in the condo segment. Leah Zlatkin, a licensed mortgage broker, highlights that even with a 15% down payment on a condo, the affordability gap in Toronto remains significant when compared to detached homes.
That's a good point, Steve. Slotkin pointed out that at the current average prices, a condo costs about $655,000, whereas a detached house is roughly $1.35 million. When you break it down, the monthly payment for a condo is approximately $2,976.59 for a 5-year fixed-rate mortgage, compared to $5,645.94 for a detached home. This makes condos a more attainable option for many looking to enter the market.
Absolutely, Sandy. For those buyers not planning major life changes, like expanding their family or relocating, the numbers make a strong case for condos. They offer a way to stay in the city, build equity, and manage costs responsibly, all while keeping financial flexibility. With listings at multi-year highs and reduced competition, this environment makes it possible for buyers to pursue larger units, better layouts, or preferred locations.
And as affordability improves, we might see more buyers entering the market, which could drive up mortgage application volumes. Lenders might see increased demand for pre-approvals and new mortgages, particularly in the condo segment. However, existing condo owners might face challenges if their property values have declined, potentially limiting their options to refinance or access home equity.
That's a valid concern, Sandy. Leah Zlatkin also cautions about the risks associated with pre-construction condo purchases. Many developers are trying to assign pre-construction units before closing due to financing difficulties and price adjustments. Buyers should be wary of uncertain occupancy timelines, smaller unit sizes than expected, and limited visibility into the finished product. Resale condos typically offer a clearer sense of value and stability.
Indeed, Steve. It's crucial for buyers to balance their lifestyle needs with long-term affordability. Choosing a condo that supports daily routines such as proximity to work, reliable transit access, and nearby amenities ensures that livability remains central to the decision. Lower entry prices can help improve long-term affordability for those planning to stay in their home for several years and manage short-term rate or market changes with greater confidence. Rochelle Gregory did not initially envision herself in the mortgage industry after completing her English literature degree. However, the opportunity to join MERIX Financial in its early days appealed to her due to its focus on people and relationships. Now, 20 years later, those core values continue to guide MERIX's operations and broker-lender relationships.
It's interesting, Sandy. Rochelle Gregory's experience shows how a focus on relationships can really define a company's growth. Many brokers who started with MERIX remain loyal after 10, 15, or even 20 years, which speaks volumes about the company's commitment to its brokers.
Absolutely, Steve. Building client loyalty is essential, and MERIX's approach is to keep brokers involved with clients throughout the life of the mortgage. Their trailer model ensures brokers are part of every renewal conversation, which not only keeps the client engaged, but also recognizes the broker's ongoing value.
And that's reflected in their retention rates, Sandy. By keeping brokers informed and involved, MERIX is able to maintain strong relationships with their clients, which is crucial in today's competitive market.
MERIX has also been adapting to changes in the market by focusing on innovation, especially in technology. Since 2021, following their acquisition by MCAP, they've accelerated tech upgrades, like launching a new underwriting system and revamping their broker portal.
Exactly, Sandy. Happy underwriters lead to happy brokers, as Gregory mentioned. By providing better tools, MERIX is able to improve communication and reduce administrative burdens, which ultimately benefits everyone involved.
And let's not forget their strategic refresh of their visual identity. While it might seem like a cosmetic change, it's actually a move to stay relevant in a market where first-time buyers are a significant force. Their new website connects with a digitally savvy community, offering resources and tools for both brokers and homeowners.
That focus on specialization and clarity of purpose is key, Sandy. MERIX deals exclusively with mortgage brokers and concentrates solely on mortgage products, which builds trust and strengthens partnerships. It's about being excellent in one area rather than spreading too thin.
Indeed, Steve. Gregory emphasizes that while mortgage products may look similar across the industry, the quality of the relationship is what truly differentiates them. Instead of just selling rates, MERIX focuses on understanding brokers' business goals and supporting their growth.
And that's a smart strategy, Sandy. By becoming a long-term partner in building brokers' businesses, MERIX positions itself not just as a lender for a single transaction, but as a supportive ally in the broker's success.
MERIX's broker-first approach also influences how they respond to changing client needs. For example, when more homeowners started calling with budgeting questions, MERIX launched Money Manager, a free tool that helps clients reconnect with their brokers and make holistic financial decisions.
That's a great example of listening and responding to client needs, Sandy. By offering tools like Money Manager, MERIX not only helps clients manage their finances better, but also strengthens the broker-client relationship. It's about being there for clients beyond just the mortgage transaction.
Exactly, Steve. Gregory mentions that if a client only thinks of their broker as someone they call every 5 years, the mark has been missed. But if the broker is seen as a trusted advisor for smart decisions about their home and money, that's when real loyalty begins to form. Let's dive into a topic that's been making waves in the mortgage brokering community. Ross Taylor recently shared an opinion piece discussing the ethical boundaries in our industry. It's a compelling read, Steve, and it certainly raises some eyebrows about the length some brokers go to secure deals.
Absolutely, Sandy. Ross Taylor points out that while competition is healthy, it sometimes crosses ethical lines. He shared a recent experience where a competing broker used regulatory threats to push his team out of the way, leveraging a loophole where only one broker can have a file with a lender at a time.
Yeah, Steve, it's concerning when competition leads to tactics like these. Taylor emphasizes that this isn't about legal issues, but more about maintaining professional integrity. He argues that brokers should avoid weaponizing compliance language just to gain an edge.
That's right, Sandy. The article highlights how some brokers might coach clients to threaten regulatory complaints, not because of any wrongdoing, but simply to clear the field for themselves. It's a strategic move, but definitely raises questions about professionalism.
And Ross Taylor isn't calling for new regulations. Instead, he believes this is something the broker community needs to address internally. By maintaining transparency and treating competitors as peers, brokers can foster a more ethical and professional environment.
Exactly, Sandy. Taylor's point is that business should be one based on service, execution, and advice, not through pricing gimmicks or intimidation tactics. He mentions how in the United Kingdom, everyone works off the same rate sheet, which eliminates these kinds of issues.
It's an interesting comparison, Steve. And while the Canadian market operates differently, there's still room for improvement in how brokers conduct themselves. Ensuring clients understand the full structure of their mortgage is crucial for maintaining trust.
Indeed, Sandy. Ross Taylor's insights remind us that the credibility of the mortgage brokering profession is at stake if unethical practices continue unchecked. It's up to the brokers to uphold high standards and prioritize client interests over quick wins.
Right, Steve. It's a call to action for brokers to reflect on their practices and strive for a more transparent and respectful approach. By doing so, we can enhance the reputation of the industry and ensure that clients receive the best service possible.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.